This week on the Retirement Quick Tips podcast, I'm recapping the economic and market conditions that are impacting you and your retirement nest egg this year. Today, I'm bringing it all home and talking about what the current economic and market conditions mean for your investment decisions. So the first impact and driver of what this means from an investment standpoint is on interest rates. Interest rates are very high, especially if you look back over the last 20, 25 years, pretty high relative to what they've been. I do not see us going back to the ultra low interest rate environment we saw in the years leading up to and during the height of the pandemic. The ultra low interest rate environment was a huge tailwind for stocks. Most investors do not appreciate this, simply because if I'm earning 0% on my money markets, CDs, that's an exaggeration, but that's basically what it was. I mean, interest rates were in the 1 to 2% range on a lot of bond investments for years. And so people look at that and they're like, why am I going to lock up my money for 2 to 5 years earning virtually nothing when I can put it in the stock market? And even a stock dividend payment is going to give me more than what I can earn in bonds. I think in the absence of getting good interest rates in owning bonds, a lot of investors just shunned bonds and invested in stocks instead. And that really favored stocks and pushed the returns higher than they otherwise would have been if rates had been a little bit higher over that period. But now we're in a completely different environment. We're in a higher interest rate environment, and I would expect that interest rates would stay higher for longer because inflation is sticky. It's more manageable now, but it still is remaining elevated to the point where the Fed is really handcuffed. They cannot reduce interest rates without spiking inflation. And they might start playing with that this year, like lowering interest rates by 0.25% of a point. See how that goes. So you might see a slight reduction in interest rates, but are we going back to the time of a 2.5% mortgage rate? I would love for that. I don't think we're getting there anytime soon. Years, if ever. Okay. So I think the higher for longer scenario when it comes to interest rates, I think is going to play out over the next few years. That is great news for bond investors, and it's just okay for stocks. It's not going to be the tailwind that it was when interest rates were low, but I don't think it's going to hurt the stock market that much either because interest rates are about as high as they're going to go. And as long as they don't kick up any higher, then I think it'll be just sort of neutral for stocks. But for bond investors, it's great. Yields on most CDs, high quality corporate bonds, I'm still getting 4% and more across most maturities. So you could buy a 1-year CD, you could buy a 5-year good quality, solid corporate bond earning more than 4% with only one small little interest rate cut expected this year. That higher for longer narrative is going to stick around. What it does is it provides an attractive entry point for investors to increase your allocation to bonds. So if you're sitting in cash, if you have too much in stocks and you're wanting to reallocate to bonds, but you don't want to give up the growth potential of the stocks. The nice thing about bonds is that you can still earn 4.5% in many high quality. Now you can earn more than that, but you're going to have to sacrifice something. You're going to have to tie your money up for a long time, like 10 years or more. Or you're going to have to sacrifice quality and introduce more risk. But I'm talking high quality investment grade corporate bonds, CDs, etc. You can get around 4%, which I think is very attractive for bond investors. You're not guaranteed that in the stock market, and the 4% is high enough where when you combine that with a diversified portfolio, it should help to enhance your returns without a lot of volatility. Speaking of volatility, in our client portfolios, I've been using this recent volatility to rebalance back to where we want to be. And in some cases, adding more bonds in, especially for clients who are closer to retirement. They're already retired. They're a little bit high in terms of how much they have of their portfolio in stocks. And it's like, yeah, let's get 4% for the next 5 years. I'd be happy with that in this particular investment. And in the context of a well-diversified portfolio where you still have the growth potential of stocks, I think it makes a lot of sense to increase your allocation to bonds at this time before interest rates start coming down. Now, I think too, evaluating your own allocation, like how much of your portfolio do you have in stocks? How much do you have in bonds? How well diversified are you? It is prudent and so important to evaluate that, make sure you're positioned well right now. Now is an excellent time to do this because markets have calmed down. We want to do this when things are going well. So for our own clients who have substantial cash or money market investments, we've continued to add to CDs and fixed maturity bonds. The other elephant in the room is AI and all the technological changes, huge potential driver for growth. Not just in the big tech companies, but we're starting to see more and more companies adopt the use of AI, ChatGPT, large language models, developments in robotics, all kinds of stuff. So I think we're going to see a huge acceleration in technological changes that are driven by AI, and that should boost productivity, should help markets tremendously. I think that's a near-term, short-term boost, as well as a longer-term boost. The last thing is international investing. That has seen a real renaissance this year. It's important to keep in mind that investing in companies outside of the United States is important for diversification, but your results from that is almost completely dependent on the dollar. If the dollar is weak, international investing does well for US investors. If the dollar is strong, which is basically how it's been for the last 15 years most of the time, then international stocks are not going to do well. And so what's happened is like investors look at their portfolio and in most years of the last decade plus, they're like, yeah, my international fund isn't doing well at all. But the S&P 500 is doing great. So they sell the international investment, put it in the US market. So many investors today are way underweight international simply because it's been kind of a blah place to be for the last 15 plus years. But that's changing because the dollar is weak this year, very weak, like historically weak. And so international stocks have done exceptionally well. And it seems likely that the dollar does not turn around. There is some weakness, not to the extent that there has been, I don't know. But, the dollar is likely to kind of remain beaten down. And I think international stocks, even with their boost in prices already, I think it's still an attractive entry point. But I want to explain this a little bit because I think it doesn't always make sense. But I think it's important to understand how international investing truly works. Just using a simple example, let's say I buy some German company's stock. And why wouldn't I? The Germans are master craftsmen. If you've ever driven a high-end BMW or a Porsche, need I say more? Okay, so you buy some German stock and maybe it grows by 10%, like in 6 months. And you're like, dang, that was a good return. But if the dollar strengthens against the euro over that same time period, you could see that 10% gain wipe out completely, depending on how much that dollar strengthens over time. So what you've had is you may have a German stock that grows up 5%, but then the dollar is down 10% over that same period. So that enhances the return. So it either cancels out or lessens the return if it's strong dollar, or it boosts your return in a big way if the dollar is weaker. And that's what we've seen. It's not that international markets are doing so incredibly well compared to US markets. It's just that this year the dollar is particularly weak, and that's been a big boost. I think it's an area that should be considered, especially if you have a low allocation to international stocks. In summary, investors should be considering boosting their allocation to bonds where appropriate. Get in while the rates are still high. AI and the fourth industrial revolution should be a tailwind for stocks despite tariffs and higher for longer interest rates. And though they've been out of favor for many years, I think international stocks provide important diversification and the possibility for pretty decent returns again in this current environment where the dollar remains weak. All right, that's it for today. Thank you so much for listening. My name is Ashley Mitchikay, and this is the Retirement Quick Tips Podcast.